forbearance agreements, and we've had zero, none, over 600 loans. We've had consistent origination volume, meaning we've still been able to continue to generate new loans. We've kept our interest rates right where they've always been, where they've been for the last number of years. We've done slightly lower leverage, meaning borrowers have put in slightly more cash out of their pocket. And we've added in additional interest reserves on the loans we make, again, creating an additional form of security that people are having reserves in case they did run into hard times and making their payments. But every borrower has made their payments each month, which is pretty astounding. So that's how we've been performing. Let me tell you a little bit about what we do. Two sides to what we do. We invest in real estate as an owner, as an equity investor, and we lend to others who do the same. So first side is us owning real estate. We do tax-sheltered real estate investing. Mainly we're investing in apartment communities. That's our primary strategy. We're investing in apartment communities, mainly 200 to 500 unit apartment communities. You can see there on the map where our apartment communities are located. So we got a whole bunch of little pins there on the map here in Pennsylvania, as you can see, and then many throughout the Southeast, the Sun Belt area. That's where most of our portfolio and our growth is, which is where people are moving, where good weather, good jobs, good taxes. So we're going in a place where population and job growth is going, which is in the South, even more specifically in the Southeast. To go out there in this market, so one thing that I think is pretty interesting is when COVID happened, a lot of us hoped, at DLP, we were hoping, all right, this is finally going to be an opportunity that pricing is going to come down, meaning there's going to be great buying opportunities. Finally, the demand for investors wanting to buy apartment communities is going to soften a little bit. That has absolutely been wrong. We were absolutely wrong in that expectation. And that's because people have realized, again, that in recessionary environments, that this is arguably the most stable place to invest. And even in this historic time of the government telling us we can't evict tenants, this asset class is still outperforming all other asset classes. So what's happened is billions, yes, billions and billions of more dollars have been raised to invest into multifamily communities. There's more money right now trying to go into multifamily communities than all other real estate asset classes combined. So a lot of people are realizing, again, this is a great place to invest. This has actually only driven up values. So what that means for us is it's continue to make it even harder to find and create value. So it takes a lot of time, a lot of effort, a growing team, and a growing focus to be able to acquire deals in this market that can still generate the kind of returns that all of our investors have grown accustomed to. So we spend a lot of time sourcing deals in a lot of ways, doing deep underwriting of those properties, going out and physically inspecting them, often then taking on properties that require us to do a lot of physical renovations and improvement and major improvements in management in order to extract the kind of returns that we generate for our investors, which I'll show you a little bit more on in a few minutes. Speaking of our ability to acquire properties, we just acquired a property about a week ago, Pepper Tree Apartments. This is our most recent acquisition. It's in North Charleston, South Carolina. So Charleston, South Carolina, great market. You might not be able to read all of this, but it's 353 apartments built in 1987. Well, between 1983 and 1889, but I think average age is 1987. And we're targeting and expecting to generate over a 20% annual return on this investment. We're going to come into this community and improve it. So who's been to Charleston, South Carolina? Okay, many of you, right? Who's been there in the summertime? Right? Pretty hot, right? Well, these apartment communities do not have central air. So that's going to be part of our value-added strategies, coming in there and putting air into these units, adding what's called PTAC units into here to get better air conditioning. We're going to also come into this community, and here's some pictures of the outside and the pool. And you'll see in the top right are what most of the apartments look like. About 60 out of 350 had already been renovated by the previous owner. So we're going to come in there and continue to renovate apartments, include adding air conditioning, and improve the community, improve the quality of our residents, improve our returns, improve the value of the asset. Prior to that acquisition, our last acquisition was Preserve at Port Royal. This is in a town called Port Royal, South Carolina. That's between Charleston and Savannah. This is a community of 400 units, a little bit newer, built in the early 2000s. And we're going to come in here similarly in this community. We're doing some exterior improvements, some amenity improvements, and then we're bringing some of the quality of these apartments from 20 years old or 18 years old to today's quality. So those are the most recent acquisitions here since COVID, since July. Coming up, we're under contract to acquire, coincidentally, we're not only targeting South Carolina, I promise you, but coincidentally another community in South Carolina, in Myrtle Beach, South Carolina, another great growing market, 188 units built in 2000. We're actually under contract on this community right now. We've been out doing due diligence over the last week or two, looking to finalize due diligence over the next week, and we'll be acquiring this community towards the end of this year. Here's some pictures, similar case. We're going to come in here and renovate some of these apartments. One of the big value creations, this property had a fire, and there's 30 apartments that were damaged from the fire, so we're doing some renovations and improving those units, potentially adding some new amenities as well, we'll generate very similar returns. This property we're expecting to generate double-digit cash-on-cash returns starting in year one. And smaller deal, about a $4 million equity check that'll come out of largely out of the DLP housing fund, in addition to myself. Another acquisition we have coming up is what we call the Gulf Coast Portfolio. This is 4 apartment communities in the Gulf Coast, so Gulfport, Mississippi, Orange Beach, Alabama, Jackson, Mississippi, and Senatobia, Mississippi. What's interesting about this community is we actually do the management on it already, and we have a minority interest in this property, and we're actually able to buy out our partners who own most of the interest in this community. This has been our best performing portfolio through all of COVID, and has been producing great cash flow over the last couple years. So we're really excited about this portfolio, built largely in the late 1990s, early 2000s, nice sizable communities. You'll notice these are all branded as Prosper communities. So we brand all of our communities as Dream, Live, or Prosper. Dream are our highest quality apartments, generally new apartments or some really great amenities. Prosper are kind of our mid-level that have clubhouses and pools and some nice amenities, but are very, very affordable. And then our Live are kind of our real workforce housing, don't really generally have many amenities, but are very, very cost effective for people to live in. So 4 very nice communities that we know very well. We know how to continue to extract value out of these. So we're really excited about this. Also targeting closing here in Q4. This is a $100+ million transaction, so be a great one that, again, largely be going into the DLP housing fund. All right, so that's one side of our business, buying communities like you just saw in those pictures. The other side is lending money to other real estate investors. So we make short-term real estate loans. And when I say short-term, these are loans generally of 6 to 12 months to full-time real estate investors. It's either for them to buy houses and renovate them, build houses, or renovate apartments similar to us. We have over 45 of our DLP team members focused on this strategy. We've done over 2,000 loans over the last 6 years, including about 600 loans so far this year. And we've had 0 loan losses to the funds on any of the loans we've originated. Over 2,000 loans, no losses, have not written off $1 single of interest on any loans in any of our funds that lend. Currently have well over 500 loans, actually a little over 600 loans right now across our lending strategy. These are loans to full-time real estate investors, so professional real estate investors. So to give you an idea, this is not the average person investing in the fund. This is the average person we're lending money to. 710 credit score, $3.5 million net worth. They've done more than 50 real estate deals, and they have 500 grand of cash, 500 grand of liquidity. That's the average person we lend to. High-quality, full-time professional real estate investors. On average, we give them a loan of 54% loan to value, 71% or 72% loan to cost. So they put a lot of cash out of their pocket to buy the property and into renovations, in addition to making their interest payments and all their other holding costs. So they have a lot of skin in the game. This is a big reason why none of our borrowers have gone into default. We've had no forbearance agreements through all of COVID, is the quality of the borrowers and the amount of skin in the game they have in their loans with us. We lend in all those states in blue, so across much of the United States. Heavily, though, on the East Coast. You'll see here, if you can read that, our top 5 states we lend in, Florida and Pennsylvania, are tied for first with 21% each. Coincidentally, that's where we're headquartered. Of course, that's where we put a lot of our focus because we're there. 9% in Georgia, again, very close to where we're located in St. Augustine, Florida. 8% in New Jersey. And then coincidentally right now, 7% in Indiana. That's not typically our 5th largest state, but it fluctuates across the states we're active in. And again, we're lending against single-family homes and multifamily communities. All right, so those are what we do. I want to touch a little bit, though, on kind of what's going on in the overall investment markets and touch a little bit on cash flow and liquidity, which are, I think many people have realized how important those two things are, especially in this COVID environment. So since 1928, there's been 54 stock market corrections, meaning the stock market dropped by more than 10%, 54 times. So there's been many times of what happened earlier this year have happened in the past. Basically, once every 1.7 years, there's at least a 10% drop in the stock market. And a lot of times it can happen even in, overall good economies, right? Nobody expected COVID and what happened back in March to see a, 30% drop in 22 days, right? 30% of the stock market dropped in 22 days. It can happen, very, very quickly, especially in volatile times such as political change, such as epidemics. So a major correction is always just around the corner. It's going to happen, and nobody ever knows when it's going to happen, what's going to exactly drive it, but it's always when. So the question is knowing there's always going to be market volatility, there's always going to be these corrections coming. How do you generate cash flow? How do you maintain liquidity? How do you make sure you can still live the quality of life you're used to in turbulent times? So, questions, we encourage you to think about as you evaluate our investments, but also just in general. Will income and distributions be critical to you over the next 5 to 10 years? Is that something that's going to be important for you? And do you have investments that you're confident will provide cash flow, distributions to you over the years ahead? Are you going to need to withdraw money in the next year or 5 years or 10 years or 20 years? Is liquidity going to be important to you? If there are big losses, are you the type of person who can weather 20, 30% losses and sit and wait it out? Because, it will recover, right? But what most people do, they say like the stock market has gone up, 9% or 10% if you averaged it out over the last 50 years, right? It doesn't actually work out that way for your return, but that's the average annual return. But the problem is most people exit when things go down, right? And they come back in when they're high because that's our human reaction, right? If you exited back in March or April, that would have been really bad to exit the stock market right at that time. It did recover largely, but again, psychologically, can you wait? Can you be patient enough? Can your financial situation allow you to be patient enough? So we encourage you in thinking about how you make investments that will provide income even in volatile times, that will provide you the liquidity you need in volatile times. So some of the things to think about even in the stock market, a place to think about is dividend-producing stocks. If you're going to be in the stock market, dividend-producing stocks can be a good place to look. Public REITs, we run private REITs, public stock REITs can be a place that can handle volatility better than most stocks and potentially can produce income as well. So what we focus on in our investment funds, our whole philosophy is no losses. So even when there's volatility around us, no losses. It's very hard to recover from a 10% drop. It takes many years to recover that. So we focus on, in our funds, no losses, consistent monthly distributions, which we provide in all of our funds, and still being able to provide liquidity. For private funds, we still provide great liquidity to all of our investors. So we've continued here through COVID, and I'm going to cover this in more detail. We've generated double-digit returns to all of our investors in the income and growth fund, the lending fund, our lending strategy over the fixed fund, all through COVID. We've hit our 6% preferred returns in our housing fund and 7% in the equity fund too through all of COVID. No decline. We never, for a day or a month, stopped distributions. We never decreased distributions through this entire environment and don't intend to whatever volatility comes after, after the election and, the impending, recessionary challenges ahead. So the funds that we run today that are available to invest into are the DLP Housing Fund. This is our fund that invests in tax-sheltered real estate, that invests in owning the real estate. This is a $1 billion fund. This is our newest fund. It's our 8th fund we've done over the past decade. Primarily, we're investing in those apartment communities I showed you a few minutes ago. This fund produces a 6% preferred return, or in other words, a 0.5% dividend every month. Each of our funds, you can choose to take distributions monthly, or you can let it compound and grow, your choice. You can change it at any time. The overall annual return target of this fund is 12% annual return net to you, and it's incredibly tax efficient, which I can talk more about. There's generally a lot of questions about that, but most of your income we produce to you is going to be deferred from tax. One of the unique things about this fund is that our management fee of 1.5% is deferred until you get a preferred return of 6%. We don't earn anything until you get that preferred return paid out every month. The other important thing to keep in mind is in our housing fund, in our real estate portfolio, we have a real estate portfolio today of about $900 million. I personally own over 40% of that real estate portfolio. In the properties owned in the DLP Housing Fund, I have over 25% of the ownership, of the equity in that portfolio. What that means is that our interests are well aligned. We're investing heavily right here in these same properties right alongside of you as our investors. These are the properties that are owned in the DLP Housing Fund. We have over 5,000 apartments already in this fund, even though this is our newest fund, including the properties I showed you that we just bought, and the ones coming up will all be in this fund as well. The other side to our business is lending to other real estate investors. We run 2 main funds that do this, the DLP Lending Fund and the DLP Income and Growth Fund, both very similar funds. The DLP Lending Fund we've been running for 6 years. We've generated double-digit returns in every period to investors. Our worst annualized return in any month is a little over 11%. That's our worst return over the last 76 months. And we've generated double-digit every month with 2 distributions a month. We pay out a 10% preferred return on the first of every month, and then we pay out a second distribution around the middle of every single month. This fund has a 10% preferred return. Again, you earn 10% before we earn anything. Historically, we've generated over a 13% return net to investors. This fund is also a private REIT. The DLP Housing Fund's a private REIT, as is this fund, which makes it more tax efficient. And also means in the lending fund you get a 1099 statement instead of a K1. Some people like that because it comes out a little faster, makes your taxes a little easier. Here's the returns over the years. That dark blue, the bottom, that's the 10% preferred return. We've hit it in every period. The middle line is the historical target of 11%, and that line that changes is the amount we've generated above our target return over the last many years. Here's our return every month for the last 6 years. Our worst monthly return was 11.04%. Our returns have come down to low 11% since COVID, and that's really just simply because we've been sitting on a lot more cash. We've been sitting on more cash, using less leverage. We've done some things to better manage our cash here over the last few months. That should create some uptick here, but we're very pleased to continue to hit over 11% through this COVID environment with, frankly, less risk. No defaults, more cash, less leverage. And then the last investment vehicle we have at DLP is our DLP Positive Note Fund. This is actually how we started managing money. This is the first type of investment we offered, which are fixed notes. And this is a very, very simple investment. You're basically lending money to our fund. In fact, you're lending money to DLP backed by real estate, and you're getting a fixed return on your investment. So you're going to know exactly how much you earn based on how much you choose to invest and how long you choose to commit. You can commit just for 90 days, 1 year, 3 years, or 5 years, your choice. All right, so those are the overview of our funds. I'm going to give you some updates of what happened now in Q3 and what's ahead here in Q4, and then we're going to open it up to questions. So this past quarter, we passed the 1,000 investor mark, which is pretty cool. In 2013, we had 33 investors, so we had less than the number of people in this room here tonight. We now have over 1,000 families invested with us, so thank you to you. But we still are hosting this dinner, having hundreds of people joining us virtually right now, and people here with us live, because we're still adding families. We're still growing. We're still continuing to raise capital so we continue to help more people provide stable income, stable growth. This past quarter alone was our biggest capital raising quarter again. We raised over $45 million in new investor capital. More than half of that came from existing investors who invested more money with us. We took that money and we lent out 145 loans to real estate investors for $62.6 million. We opened up 34 new lines of credit for borrowers, which helps them to go out there and acquire deals so they know what the terms are that we're going to lend to them. We made some really big moves here in this past quarter. I know that says key hires in Q2, but it's actually here in Q3. So we added Bo Parfait, new managing director. We added Robert Greenberg, our new chief acceleration officer or chief marketing officer. We added a new attorney with a deep background in handling default loans. Unfortunately, we haven't given him any new default loans, but in Jeff Goodman. We added a director of construction in Tim Moxley. We added our director of rental financing, Matt Zhao, right here. We added a new capital markets quality coordinator to help improve the quality of our loans, Abby. We added a new operational analyst and support member to the capital team here in Lauren. We added a talent development manager in Sarah. And we added a new fund accountant in Victoria. And we are not done. We've already added some great new team members here in Q4. We have Chris Phillip here in the back room, who's our new VP of pre-construction. He's leading all the construction analysis and review of every property we acquire, helping us maximize every dollar. Welcome you to chat with him here tonight. Here's a little bit about Bo, and I'll let Bo kind of introduce himself here tonight and chat with some of you. But our newest managing director, joining our capital leadership team with Larry and Rich, and brings a great background in wealth management, investment management. It's going to help us, and he's helping lead the launch of the Prosperity membership that some of you are joining us at in a couple weeks, and I'll highlight in a moment. Robert, our head of marketing, who came from one of our top lending competitors. Jeff, our associate counsel. Tim. So I'm going to move a little fast since I already kind of mentioned all them, but you guys can see these in the quarterly report that will go out, I think, tomorrow. All the fund reporting have all gone out, but this report that'll give you all this info will be out to all of you, if not today, tomorrow, and you'll be able to read all their bios in more detail. But great new team members. So in this COVID environment, if all you hear about is unemployment and people laying people off, we are adding a tremendous amount of new talent to help us keep growing. That tremendous new talent is going to help us to continue to do this, which is continue to exceed return targets in all of our funds, which we did once again this past quarter. Oops, don't know what I just did there, but let me get somebody to fix that. Whoever's got the presentation, it went out of presentation mode. There we go. Oh. So it's been, in short, a great quarter. Real estate market, despite all the COVID environment, it's been a really, really phenomenal market. So in Q3, we broke all-time low occupancies of homes available in almost every market in the country again. We saw tremendous growth in home prices this past quarter, which I'll touch on. But let me go back to the last couple slides. So this is the property I showed earlier. This was the acquisition we acquired in Q3. This was our largest acquisition ever in the housing fund, about a $60 million acquisition. But it's been a hot market. For real estate investors, it's been very hot. When they list a home for sale, generally a renovated home is selling in less than 2 weeks, generally with multiple offers. In almost all cases, we've seen our borrowers sell their houses for more than what we appraised the property for, more than they valued it at when they bought it 6 or 7 or 8 months before. Inventories at all-time lows. It's very hard to find homes today. The demand far exceeds the available homes in the market. On the rental side, same thing. Demand is incredibly high. That's why we're at all-time high occupancies. Nationally, we're at 95.5% of all rentals are occupied, which is near all-time records. Rents went up even in this COVID environment, even with all this unemployment, by about 1% this past quarter, year over year. And in the affordable sector, there was even bigger growth in rents than in the higher dollar sectors. Delinquencies is the big challenge right now. across the country, depending on the location and the asset class, delinquencies of people not paying their rents are 4 to 14%. So it's not what you hear on the news. Not everybody stopped paying their rent. Certainly higher than normal, largely due to, again, the fact that if somebody decided to stop paying back in April, many states, there's been nothing you've been able to do about it in terms of getting them out. So it's really a small percentage of people in the scheme of things who have been unable or unwilling to pay their rent. In terms of what's ahead, so we expect to see sales volume continue to grow. We had record-breaking sales inventory this past quarter despite the low inventory. Home prices here in the Valley, as an example, went up over 9% year over year this past quarter. We expect supply to stay at all-time lows. There's just not going to be enough supply to keep up with demand. We expect to see prices continue to go up. We expect interest rates to stay really low. We expect rental occupancy to stay up at these all-time highs. And we expect to see very modest to maybe even no growth in rent price conservatively. So all those things say this is a really, really strong market despite the challenges in the global economy. So in Q4 at DLP, what we're expecting to do, so last quarter was our biggest capital raising quarter ever at about $45 million. We expect this quarter we're going to raise over $50 million in new capital, which we are on track to do. And then we're going to deploy that capital out into over $150 million in new acquisitions. We expect to acquire over 1,500 apartments this quarter. We expect to originate over $150 million in new loans and line of credits to borrowers this quarter. And we expect, of course, to hit or exceed all of our return targets in our funds once again. So with all that said, I'm going to take a break here from talking and let one of our great investors, Karine, tell you a little bit about her story. Larry's going to take the floor there, and then we're going to open it up to some questions, and then I'm going to hit on a couple upcoming events. We're going to do a little raffle, and look forward to chatting with some of you more one-on-one. So, Karine, come on up.
Awesome. Let's give a hand for Karine.
Hey, thank you. Thank you.
So, one thing I wanted to ask you, Karine, of course, I'd love for you to tell us how long you've been with us, what you're invested in, kind of a big picture of your relationship with us at DLP, please.
Okay. Well, I've been with DLP since about 2015. It was 2014, 2015, something like that. And I'm invested in the DLP Lending Fund and the Income and Growth Fund. And with my DLP investments, I've invested in not only my cash, but I've also been able to leverage my IRA, my 401k, and even my HSA.
Awesome. And you're an astute investor, Karine. We know that already. But one of the things that I wanted to touch on here today was obviously nobody expected what started in March. So in general and specifically pertaining to your investment strategy, how, if at all, has your investment strategy changed since, say, February, March? And how, if at all, has that changed your view of your relationship with us at DLP?
Well, I think that the biggest thing for me is that I had created a strategy for myself to have a passive investment income, providing me income in case I ever had any kind of early retirement situation. And what happened for me was with the pandemic, I ended up having to live full-time with my parents who were in their 90s, taking care of them, in addition to a lot of the companies not having employees coming there. So I am an independent contractor, and so my business kind of fizzled out quite a bit. And it gave me the opportunity to spend the time with my parents, taking care of them, while I could count on an income coming in consistently through various, with my 401k has been growing, my IRA has been growing, and my cash investments have been giving me my living.
Awesome. That's great. And one other thing, you've introduced numerous folks to us, and we're very grateful for that. What would you say to folks that are considering investing with us, someone who's still maybe doing due diligence on us? What are some things or one thing that you might say to those folks today?
I'd say look at some risk factors because, I'm not a gambler, even though I'm a statistician by training. I am not a gambler. And I don't understand the stock market. There's too many unknowns. It makes me feel very uncomfortable. So I would say look at what you feel very comfortable with. Where do you see the risks as being mitigated the most? And where do you see the expertise that you can rely on someone else? Do you want to rely on yourself, or do you want to rely on someone else who's more of an expert in the field?
Awesome. Corrine, thank you so much. Let's all give Corrine a hand for her great answers. Thank you so much.
Awesome. Thank you, Corrine. All right, so last slide or two here, and then we'll open it up to questions. Larry will come around, as he said before, and you can either write down your question if you'd prefer, or Larry will have you tell it to him, and he'll ask it out for you. All right, so coming up I'll throw this out a last chance for anybody here live, anybody virtually. If you want to join us, literally, this is no sales pitch. I think we can fit a few more people. We have space limitations due to COVID, but we have right now 172 of our investors coming to join us at the Prosperity event here in Ponte Vedra. And the other cool thing is we actually have a lot of our best operators that we lend money to also coming at the same time. We're kind of running two events at the same time, one for our borrowers and one for you as our investors. This is going to be a 3-day event focused on building a legacy. We're going to have some really cool experts come in on tax, on estate planning. We have some really world-renowned speakers coming in. We have some professional athletes coming. We have some New York Times bestsellers coming. And we're going to have some pretty interesting content that myself and Bo and Rich and Larry and team are going to be sharing. It'll get you to think about, I think, life, family, wealth, a little bit differently. Give you some time out of the day-to-day to kind of focus on what you want your legacy to be, how to best maximize your wealth, minimize tax. We'll be doing this event right after the election, so depending on what happens there, maybe some talk about any tax changes, and we'll have some experts there to give some insights there. So if you're able to join us, we're not streaming this event live, but we're doing or virtually, but we are doing it live, as I said, Ponte Vedra, which is right next to Jacksonville. If you're flying in, that's where you would head into, which is right next to St. Augustine, where we have our Southeast headquarters and where I reside much of the year. So that's, again, just a few weeks, November 12th to the 15th. You can go right to our main website, DLP Capital Partners, and find event link, or you can go to dlpprosperityevents.com. Check it out. We will be doing this again in 2021 in March, and then likely again in July. This will be something we do a couple times a year, or 3 times a year, I should say. But we'd love to have you come to our inaugural event and come have a great time. We're going to be doing some pretty cool things and sharing some pretty cool news as well on some of the stuff we're working on at DLP. So hopefully to see you. And I know some of you have talked already here tonight, are joining us, so thanks for that. And welcome, if you haven't signed up, to reach out to Larry or Rich or somebody on the team, and we'll get you Mike or Bob, and they'll get you set up or tell you more about it if you want to come and or thinking about coming yet. All right, so here's some of the people who are going to be there. Some people I just mentioned. Some of the content we're going to cover. So it's going to be a very, very cool event for sure. All right, other stuff we have coming up. So at the beginning of that event, we're doing a dinner event like this on November 12th. We're also going to stream the event virtually for that event, so you can join us for that from anywhere. January 20th will be our next live stream dinner event, like we've done. Many of you have joined us earlier this year, virtual only type event we're going to do on January 20th. And then our next webinar, if many of you have joined our kind of weekly webinars we've been doing them more monthly now. Our next one is December 10th. So you'll be getting the emails on these, but just highlighting some of the things we have coming up. With all that said, I'm going to open it up now to questions, and then we will be giving away a raffle right after. So questions, just raise your hand, and Larry will come on over to you.
All right. What's your question?
Donna.
Donna, what's your question?
My question is, how are you mitigating hurricane risk? I see a lot of your properties in kind of vulnerable areas.
Well, unfortunately, there's not much we can do to stop the hurricanes or avoid them. And you're absolutely right. We do have a lot of properties in, coastal areas and paths of storms. The nice thing, though, is we've grown is for any storm that comes through, it's actually a minority of any of our properties that are in any one storm, which is actually a really good thing from a risk standpoint and even from our cost of insurance, because our insurance carriers, they get to look at our total portfolio as a risk, so it helps us actually get really great insurance pricing and have very, very good insurance. So we've had many hurricanes, we've had many, situations of flood, fires, you name it. When you have, 11,000 plus apartments across 19 states, you're going to have these things happen. Natural disasters happen, and what's been been great is we have a great insurance team who manages our insurance risk. And every case that we've had an insurance situation, we've been very fortunate. We've had in any of these hurricanes, any of these situations, we've had no serious injuries or deaths. So we do a very good job of communicating with our residents and prepping and preparing for water damage and preparing our staff and having everything in order for anything that happens, having the tarps on hand, depending on the severity of storm, having windows boarded, all those types of things. And then anytime we do end up with damage, like we did recently have damage at one of our properties in Alabama, generally our insurance more than covers the cost of damage. And kind of one of the nice things that happens almost any one of these storms, you end up with roof damage, and we end up with new roofs, which thing is with roofs, they always need to be replaced at some point. So we end up with roofs often that are 10 or 15 or 20 years old, that we end up with brand new roofs and brand new other things. So financially, frankly, we end up making out in storms because of the way we structure our insurance. It's a lot of work and a lot of strain on people, both residents and our team. But financially, we have never been in a situation where our investors have been hurt or had to come out of pocket due to a storm situation.
Don, thank you very much. A great presentation as always, and thanks for the insight. One of your slides up there spoke about, as a result of the quarantine, COVID-19, that we're looking at, I think it was evictions or ejectments from 4 to 14% increase. So how do you see that as an opportunity for more product coming into the market? And how well is DLP positioned for that in terms of, I guess, what states do you think the greatest opportunities, and how do you see the funds benefiting from that?
Yeah, that's a great question. So his question, and what the stat he's referencing, you see on the screen here, it says that right now delinquencies range from 4 to 14% across the United States, and that depends on market, depends on asset class, but also depends on management. And a lot of especially smaller management companies, less experienced management companies, have really struggled, and they've been in some cases I'll call it taken advantage of by residents, and haven't known how to handle it well. So we know many management companies who've stayed closed through all of COVID. Their offices have been closed. They haven't been doing service requests. They haven't been out collecting rent. They've been closed. Many management companies just haven't been able to handle it right for a variety of reasons. So there's many companies, despite the overall stats, maybe 4 to 14%, there's certainly many communities across the country that management is drastically struggling, and they're facing 20, 30, 40, 50% delinquencies. So the way I like to think about it, even though I got done telling you how great this strategy is and how great it's performing, that's the market as a whole. DLP nor any investor buys markets. You buy deals. And so there's going to be deals where the management ownership isn't doing as well, whether they're just not doing as well on that property because they don't know how to manage through these challenges, or we have some of the deals that we've been working on or we've acquired, the property's performing great, but the ownership is hurting because other investments have been hurting really bad. So example, we've bought some deals from guys in the energy business or in hospitality where they're in desperate need of cash, where they need to liquidate fast their income producing assets to generate cash for other businesses or properties they own that are struggling. So when there's high delinquency, when there's heavy unemployment, when there's recessionary environments, that creates distress, and distress creates need for people to get liquidity quickly, and that's where we come in. And the market is incredibly strong for people wanting to buy multifamily if it's well managed and if it's cash flowing well. Properties that are not well managed and are not cash flowing well are not selling at great prices because what drives people to multifamily is cash flow. So there's a property with a lot of delinquency, a lot of vacancy. There's a very small pool of buyers who are able or willing to tackle those types of properties, and that's where we specialize. So there's going to be distress for sure in the cycle ahead. So thank you.
So we're going to turn to Zoom now. We have a question from Zoom, and Rich is going to give that to us right now.
Great, thank you very much. This question is coming in from Tom, and it's asking Don on the status of the acquisitions. Do you have an update on the large portfolio DLP was working on?
So in some of the previous events and webinars, we've talked about a large portfolio. We've been calling the 2X portfolio, which would double our size of our portfolio. It's an 11,800 unit acquisition. So I'd say today I'll say there's a good chance that it happens. Tomorrow I may tell you there's no chance, and the next day I'll tell you there's near 100% chance. But it changes day to day. It's a complicated transaction. We've been working on it for many months. We've been very close to being fully under contract, and then taking a step or two back. Basically, we're dealing with two owners who basically don't like each other, and one will agree, and then the other will change his mind, and then one will tell us we have. So it's been a fun deal, but $1 billion plus size transaction should be difficult, is what I keep reminding myself. It should be hard. And it certainly has been. So it may happen. We're working on some other good-sized portfolios ranging from 2,000 to 4,500 units as well that we're in different stages of negotiation on. So, in short, we do expect that there's a number of owners like we referenced in the last question who are in different stages of distress, and we expect to be able to acquire a large portfolio here in short order. But very hopeful still on that deal. It's an incredible buy, but still working hard on it every day. So. Thanks for the question, Tom.
Hi. I was just curious on the reinvestment of acquisitions and turning it over. What percentage of properties that you purchased do you turn over within short periods of time? And what's the success rate of some of the companies that you use to do that?
And by turnover, do you mean sale of the property?
Yeah.
Okay. Or renovation of the units? That you mean?
Yeah, renovation and then resell it to when the values increase.
Got it. So first, in terms of the renovation of the apartments, every property is a little different, but some properties we come in and we do full renovations of 20, 30% of the apartments. Some of the times we're coming in there and renovating 100% of the apartments. It really depends on the condition, the market, and a number of other factors. The average across the nation, last time I looked at the stats, the average occupancy of a multifamily apartment is about 14 months, is national average. We aim to be much, much higher. We'd like to achieve an average of 4-year occupancy. When we come into a community that was leased by a previous management company, often the properties we buy weren't managed all that well. There's often a good amount of turnover. Especially in the beginning, until we come in and we improve the amenities and we improve the feel and the management and the way we take care of the residents. And then generally people want to stay. And we often sign people on 2-year leases, renew their leases for 2 years at a time. We really want to create a community that people want to stay in. But generally when we come in, I would estimate somewhere between 50 to 75% of the residents do turn over the first 2 years of the investment. In terms of how long we own our properties for, we generally underwrite a property that we're going to own it for 5 to 7 years, but we'll be willing. Sometimes we sell it faster, sometimes we hold it longer. It just depends on a variety of factors, including, what's going on in the market, how well the property is performing, what we think the future is going to hold. We've had properties that we've gotten such incredible offers on that we said we'd be crazy not to sell. So, over the last 2 years, we've sold about $300 million worth of communities we own. Right now, we're in process of selling 7 or 8 of our communities right now that are under contract to sell. So, we're constantly evaluating our portfolio and deciding which properties do we want to own long-term, which ones make sense to realize those gains, defer them from tax, but realize those gains and reinvest into a new opportunity. So.
Thank you, Don. Next question coming in from Kenny online asked, do you expect 2021 to be more of a buyer's market or a seller's market?
So I'd say in both single-family homes and apartment communities, I don't know which one the question's referencing, Kenny, but I would say both are going to be very likely very strong sellers markets. Obviously, look, we could all have a little bit different opinion of that next week, depending on kind of what happens. But right now, the fundamentals of supply and demand, both in homes and apartment communities, there's so much more demand than supply. So expect both markets, as the market whole, to remain seller markets over the year ahead. And again, nobody knows what's going to happen with COVID and what's going to be the government's reaction to what happens with COVID, and if we're going to have any shutdowns again and how those things could affect things. But I think we just went through the craziest environment that nobody could have been prepared for. Anything that happens again, we're going to at least be somewhat prepared. And our portfolio has weathered it and performed well. So I think whatever volatility comes, we welcome, and we'll find ways to prosper through it.
Great, thanks again. So the next question is coming in from Bob. He'd like to know what you believe are the risks and impact of the election results, particularly on real estate and the DLP funds.
So yeah, that's I'm not surprised to get that question, right? So obviously none of us know first when we'll even know, who won. So that's a factor where nobody yet knows. But for a couple points of optimism is, I think, if we take a step out of people's specific political beliefs and the fear and whatnot of what could happen, is it's never ever as good or as bad as anybody ever thinks, right? It's the world doesn't end no matter who's in office. And generally, for a point of optimism, generally, when a new president is in place, instead of a president being reelected, when a new president comes in, generally the economy does better on first term of a president than second term. It's been proven almost every single president, first term presidents, the economy performs better than second term. So that's a point of optimism if there's a change. I know most people think the opposite will happen for understandable reasons. But I just think, it's never going to be as horrible as anybody thinks. And in our world of housing, we feel very strong for all the reasons we've talked about tonight. Our performance will be strong. And we buy and lend on properties in distress, in some stage of distress, in some stage of value creation. So when there's volatility, when there's fear, when there's distress, that creates great opportunities for us. So I think it's going to be exciting times, regardless of what happens. And who wins the election. There's going to be some challenges and some headwinds whoever's in office are going to face in the next year. But I think everybody in this room and online, we'll all be okay. We live in an amazing country. If you're in this meeting, you're probably in okay financial position, and that's probably not going to change regardless of who wins the election.
Raising the corporate tax rate to 39%. Does that apply to all businesses, or would y'all be in that club, category?
Yeah, so certainly his question was, if the corporate tax rate goes to 39%, will that affect all businesses? So it only affects C corps. So it doesn't affect most small businesses because we don't face double taxation. We're not taxed at the entity level. It's just a pass through to the owners of the company. So example, in any of our funds, there's no tax at the fund level. It's just tax at the individual owners, partners level. So it doesn't affect us at DLP directly, or you as investors in our funds directly. Certainly the indirect effects are, is that generally if there's more tax, companies hire less people, they don't grow, they don't invest as much into their companies, those types of things that can affect the overall economy. But the direct effect on, you and I is probably minimal. It's kind of the indirect effects that more tax means less growth generally. But a good question. Anybody else?
We have a question coming in online from Steve, and it's a typical question we get often, which is on deployment and wanting to understand with the pipeline when we expect deployment to occur.
So I say this, partly jokingly, but it's 100% true. 99, would you say 0.9 or 0.8, Larry?
I would say 99.98.
99.98% of investor complaints revolve around we didn't deploy their money fast enough, That's pretty much the only complaint we get is we want our money deployed faster. So we get the question. So historically over the last many years, we've averaged 21 days for full deployment. When COVID hit, we had longer deployments for a couple reasons. One, because all of you made the decision to invest more money with us, and it became our biggest capital raising quarter ever until this past quarter. And so we had more cash coming in, and we made decisions to really take our time and evaluate what was happening in the world. So we didn't buy any properties in Q2. We continued to lend, but a lot of transactions slowed down. They got delayed. Closings couldn't happen. Real estate offices were closed down. So we sat on more cash, and we couldn't deploy money as fast because we had cash sitting. So we went up, a little bit higher in some of our funds to, 70, 80, 90-day type deployments. I'd say if I were to, and I don't have, of course, the data right in front of me right now, but I would say in our lending fund, our income and growth fund, I would estimate today, 3, 4, 5 weeks is kind of what we've been averaging over the last few months. In the housing fund, I wouldn't predict much more than that because we have incredible volume of deals that we're acquiring, as we showed a few moments ago. But for anybody who is really concerned over it, we can talk to you about doing a capital call structure where you sign your paperwork, you commit, and then we call your money when we're ready to deploy it. But again, normally we deploy in the standard, in most people's world, a short amount of time. Many of the fund managers who run funds such as us, they run all of their funds on a capital call structure. And that can mean that they never call all your money, or it's very common that for large funds that it takes 12 months, 18 months, 24 months to deploy your money in a capital call structure. So I think we've spoiled people a little bit, and people want their money deployed right away. When you invest in our DLP positive notes, you do get deployed day one. And the rest of the funds, generally, it takes a few weeks. But we'll always do our best to give you an expectation of how long that's going to be based on the demand. But keep in mind, we're never going to take undue risk just to deploy your money. So if we think, hey, we got a big acquisition coming end of November, so we're going to deploy your money by end of November. If that deal gets delayed a month, it takes more time. We're not going to go and take undue risk just to deploy money. So once you're in the fund, you'll appreciate that, and appreciate that we're not deploying money just to deploy it and taking an undue risk. But we have to balance that. The number one challenge I deal with in hitting our returns is managing the cash deployment process.
So I think we're ready for the raffle, Don.
All right, sounds good. So let's see here. So I hit the top button. Let's see. So all of your names, this is the first I've seen this. So all of your names here are on these little slides. So let's see how this works. We have Matt. But we can't choose him. He's a team member. So we gotta do this again. Let's try this again. Can you tell this is real? So we just ended up with a team member here. I don't know if I can do it again. IT may need to help. There it goes. All right. We have Mark Plaza. All right. Mark here? Oh, don't tell me I'm going to do this again. Right? You have to be here, right? Is that the rule? All right, here we go again.
He's virtual.
Oh, is he virtual? Well, we might have to give you out two, I guess. David. David here, is he virtual? So I guess we have virtual guests as well?
There is a David. Yeah, I say we go.
We're going again. We're going to get somebody live here. All right. We have Edward.
Virtual.
Don't tell me. We're testing this out the first time. We'll do better next time. All right, let's try again. And what are we giving out here, Larry?
I don't know anymore if we're giving away 20 of them.
Here we go. Congrats. All right. And Larry, what does Helene win?
This is an extended weekend in any one of our vacation properties.
All right, awesome. So I know you're joining us in Ponte Vedra already, but we have vacation properties in Asheville, North Carolina, St. Augustine, Florida, St. Simon's Island, so many of you have been. Who's been to one of our vacation properties here? Only a few? Wow. All right. Well, you're going again. All right. Well, thank you. Sorry for the multiple tries there. So, of course, from here tonight, we don't have any paperwork with us, as far as I know. We don't have anybody in the back to take your checks. Today was about giving you information. So, after today, if you have interest in learning more, whether you're an existing investor or prospective, you can reach out to whoever you've been working with on our team. If you haven't yet been working with any of us, pick who you think is the most handsome there. Don't pick me, and they'll gladly help you out and support you in evaluating us further. We'll also can provide anybody here with a link to our investor portal where you can see all of our historical returns and audits and financials and everything you could ever want to know about our investment funds. So thank you so much for everybody's attention here tonight, for braving it out and joining us here live, as well as for staying with us here virtually. And have a great rest of the evening, everybody. Look forward to chatting with some of you here tonight. Thanks.